Hi, I'm Arn Menconi again, and I have a guest that we've seen before. His name is James Henry. He was a former senior economist with McKenzie. He's an attorney, and he's worked on two documentaries about tax justice. And he's here today to talk about the recent news that's been going on in the economy. We've seen a lot of meltdown of the stock market in China. We saw oil drop to below 20, I believe it was $27 a barrel yesterday. It's back up over 30. The stock market almost went down about 500 points yesterday, and it's gone back up. So who better to talk to than James Henry? How are you, James?
Great. Good to
I,
be with you.
I know you've been on a lot of interviews, very sought after to find out what's going on. You can follow him on Twitter. He's writing every day about what's happening. So frame the conversation for us. It's the start of January. Markets have never opened up this low before. What's going on?
Well, until today's minor recovery, we've had about a 20% decline from peak 2015 levels in Europe. In the U.S., more than 10%. So the 20% correction in Europe qualifies, in the language of financial analysts, as a bear market. Today, the head of the European Central Bank, Draghi, noted that the central bank was prepared to reduce interest rates and stimulate market activity no earlier than March, however. But that was enough to at least put a bottom under this market temporarily. So we've had one day of reprieve. But the big picture is we still have a lot of uncertainty about what's going on in one of the most important engines of growth since 2008's financial crisis, which is China. China is not only a big market for developing countries that produce commodities all over the globe, like Brazil and South Africa, but it is also a major competitor, potentially, of countries that are worried about whether it's going to have a currency devaluation, which could trigger a currency war. So, you have Japan and South Korea, Philippines, Indonesia, and Europe worried about Chinese growth as well. Australia, which sells about 33% of its exports to China, a lot of commodities, has been severely impacted. And so you have, in addition to China's currency weakening, you also have currencies like the Mexican peso, the South African rand, the Argentine currency peso, the Australian dollar, Canadian dollar plummeting. Some of this is also aggravated by the fact that we have a real slump in oil prices. So worldwide oil prices, oil is trading at $27 per barrel. That's in real dollars. That's early 2000, late 1999 levels. And, it's aggravating conditions for oil producers like Venezuela and Nigeria. But the main driver for this, the slump that we're seeing since late December, is the Chinese uncertainty, and that's what I'm concerned about.
So a simple way of putting it is the Chinese market. We don't have enough time to get into how new it is and how it's got a sort of a communist centralized policy setting mechanism in place and what's trying to be a free market economy of sorts. But what's happening is they have reached this level of maximum capacity for right now in build out. So they don't need as much rebarb, copper, oil, etc. So they're not purchasing as much, and that's having an effect on commodity prices around the world.
Well, the real problem here is that China's growth has been powered, just like the mortgage market in the United States, by debt. China now has a debt to GDP ratio north of 250%, and it can't keep on borrowing to finance domestic projects. Most of that debt is domestic, but that doesn't matter. The issue here is what's become of all that money.
Right.
And we suspect, but don't know, that a lot of it, like in the U.S. Crisis, has gone into projects that may not really have made sense. And so, overbuilt real estate projects all over China. Reports of tremendous excess capacity in core industries like steel and coal.
Right.
And so China's in the middle of a transition to an economy that relies less on state-financed investment for growth and more on the household sector. But the household spending is only about 40 to 45% of GDP, whereas in a developed country like the United States, it's more than 75%. So that's the transition China is struggling with right now.
Well, we're just outside of Aspen, where a lot of the top people chose to go to Davos, Switzerland, instead of Aspen. They're meeting. They're talking about the issues that are going on. How does this affect people in Middle America and the poor in America? None of this is going to really matter to us unless there's a big meltdown, because all we're seeing right now is cheaper oil prices. But what's the possibility in an election year of this thing either stabilizing, getting better, or going much worse?
Well, there's several potential risks here for the U.S. market. Although the U.S. is relatively well off, a lot of people are parking money, including the Chinese. More than $1 trillion of Chinese flight capital has poured out of China in the last year. And much of it is ending up in the United States, real estate markets, or in Canada. China, voting with their feet to seek safer investments, not in China. But the U.S. economy still faces some risks. First of all, we have major banks on Wall Street that have made pretty significant investments in China and are exposed. They're also exposed to the oil industry because they financed a lot of these fracking producers, and a lot of them are going to be underwater, may have debt payment problems. We do have quite a few people now employed in the U.S. oil industry. It's north of 1 million workers here. So it's we are once again one of the largest oil producers in the planet. So the oil outlook does affect us. But again, I think
it affects Canada a great deal too.
Most of our exposure will be indirect. For example, Mexico right now, the peso has gone into a collapse. It's 18 per dollar. So we may, if the Mexican economy has more difficulty, you're going to see increased emigration from Mexico to the United States, just like we've seen in the past. That's obviously a hot issue, and it's going to aggravate things. We have our neighbors to the north, Canada. The Canadian dollar is now 70 cents.
Right.
And Canada is struggling with what it's going to do to prevent a fairly deep recession here, because they were relatively unimpacted by the mortgage crisis.
What I'm trying to understand, because I've been going through this, following the markets and following the economy for some time, is we should kind of look at it like there are some short-term benefits. The dollar is almost equal to the euro. So if you go to Paris this month,
if you want to traveling, this is a great time to be in America.
If you want
over Europe for $1.08 per euro, I mean the pound is down to 140.
Right.
The Canadian dollar is 70 cents. The Australian dollar is 70 cents.
Right.
And Mexico and South Africa, these are places that are much farther away, or in Mexico's case, close by, but it's also of interest. But South Africa, if you can stand the 16-hour flight, I mean, you can live quite handsomely right now in Johannesburg.
Well,
I think that from our standpoint, it will help any industries that are basically dependent on imports, because the dollars become stronger. It will help travel services, but it's going to hurt domestic oil. It's going to hurt those who are going to be competing with cheaper products.
So where do you think? I want to frame something here. In the last 25 years, the top 5 or 6 banks in the United States have increasingly grown their revenue share of overall profits. Mm-hmm. And they are now one of the largest sectors that is growing at the fastest rates. In addition, we've seen just the opposite happen in the effect of wealth for the common man. We've become more productive, but have less revenues. It's the inequality gap that continues to go on.
Median income in the United States in real terms has declined since 1999. Median household income has fallen.
Right.
And so median means the guy right in the middle of the income distribution. So the folks at the top are the ones who benefited from all the, most of the benefits of the financial recovery since 2008. Even though the economy here is growing 2 to 3%, there are pockets like North Dakota where there's a lot of people working in the oil industry and they're better off. But we still have a kind of an underemployment situation. There are a lot of people, I suspect, in the labor market that are on the boundaries of the labor market. The unemployment statistics, the official ones, are down to 5% or lower. But, the underemployment here, which consists of people taking jobs below their skill levels or basically dropping out of the labor force and not looking for work, retiring early and, just giving up. I mean, there's a substantial amount of slack and of underutilized people in the labor force. And I think at the other end, you have young people taking jobs below the skill levels, below the sort of things they set out to do when they started, when they entered college and, working in restaurants and as waitresses and things. So we've seen a lot of growth in kind of low-end or even temporary jobs in this economy,
right.
And much less in terms of longer-term career-type positions. And so the quality of the labor force is a real issue.
Well, how do we call out the top banks, those 5 banks? You're an expert. You've written books on the banking industry. They're going to survive very well in this sort of what I call pump and dump atmosphere of rising prices up, it goes down, rising prices up, goes down. How are they looking at this issue as an opportunity for them, or how are they coming out of this? Because it's always interesting for me to watch the super rich. You sent me an article, Oxfam came out yesterday. 62 people in the world own 50% of the wealth, which is roughly about 3.5 billion people. Bernie Sanders.
I have a problem with that study, but I think, there's no question that inequality is growing. I mean, what Oxfam did in the study was, in a sense, kind of discredit itself because it lumped together all the, people at Harvard Medical School on, student loans and their loans and their debts with people who are, poor peasants in Botswana. Because, there are a lot of people who have borrowed and have negative net worth because it's a temporary phenomenon. So down the road, they will. But, so you have about 1.4 billion of the 3.5 that, have positive net worth and are, buried in this statistic. But anyway, the point is, inequality is a major problem for the world economy. It is has many different roots, but I think one of the worst roots is just government policy. We are not levying anything like the progressive taxes that we used to levy on companies and individuals. And we have taught ourselves to believe that government doesn't need or deserve the money. Every time you read about corruption, you wonder why am I bothering to pay taxes? And we've taught ourselves to believe that government isn't necessary. That somehow we're going to have schools and hospitals and roads and security systems and wars in the Middle East without anybody paying taxes. And all this is nonsense. We need to revitalize and defend strongly the vital role of the public sector in generating the economic base that the private sector needs in order to prosper. Not only all the infrastructure that roads and bridges and dams and capital goods, for clean air and regulation, but we also need a rule of law, regulation. This doesn't come cheap, and it's essential because what we've had since the 1980s is kind of the I would say, deregulation of the financial system. So you have the major banks go to work in Wall Street, spending $3,000 per day per congressman on influence and contributions there since 1990. And it's paid off for them. They have, achieved they've gotten away with a lot of deregulation, and they got huge bailouts in the 2008 financial crisis, and now they're back on their feet. But you have the top six banks, which in 1990 had less than 15% market share, now have something like 60 to 70%. So it's a tremendous concentration of economic power in the hands of institutions that are, heavily engaged in, financial trading. I mean, who's speculation? These are not venture capital firms. The banks are not in the business of taking, sponsoring innovation. I mean, there's a certain kind of capitalism that the United States should pride itself on, which is, creating new opportunities and new kinds of solutions to problems. But this isn't what banks are engaged in. They're involved in a kind of arbitrage and a kind of clever chicanery. So in the world of the stock market that we just mentioned, what are the banks doing there? Well, UBS and Credit Suisse and the other major Wall Street banks, plus a few hedge funds, have invested heavily in what's called high-frequency trading. These are systems that now account for a majority of all the trading going on the stock exchange. And they're basically computer algorithms that are operating at microsecond speed that most of the rest of us can't keep up with. To some extent, they may be front-running the market. They look at the trades that are going on and get an early look at that, and they jump in and for a few seconds, are able to take advantage of that information. So this is an area where we need stronger government regulation. And that's been what's the problem is that we're facing is not so much a technical problem. It is a problem of political will and of the outsized influence that the financial services industry exerts in Washington across both parties.
Well, we started off by saying what's going on in the last few weeks in the market, what could be happening in the next few months or to the year, and then we started to frame it over the last 25 years. So let me take a crack at this and say it maybe a little different way. Is you're saying that we lack this Keynesian economics, this monetary policy that helps prime the pump, put money back into the economy. You're saying that there isn't regulation and or taxes that's combining and bringing some kind of order to the economy so that you can actually fund some of these things that would create more jobs, build more infrastructure. You didn't really touch on the fact that the fiscal policy for the past 7 years or so has been essentially lowering interest rates to zero and putting a lot of money into the money supply, which the people who've been able to capture that is, again, the top banks. They've been holding on to these dollars, investing them in things like high-frequency trading, and there's been a huge growth in stock buybacks by these corporations that are sitting on all of this cash, essentially. And when they do a stock buyback, their profits go up. The CEOs rake in huge bonuses. So is that correct? Am I correct in saying that?
We're talking about a lot of things at once, but I think if you had to put your finger on a few things that we have decided in this recovery period, because we have basically, not just Republicans, but some Democrats as well, who have been opposed to financing government with taxes. And, nobody loves taxes, but there is a reasonable level of taxation that we ought to incur, as opposed to going deep into debt, which is how we paid for the Iraq War and how we paid for most of the financial recovery. So in this period, we've leaned very heavily on monetary policy run by the U.S. Federal Reserve. We have these low, zero real interest rates for a longer time than anyone can remember. Very pro-bank policy, as you suggest. And at the other hand, we've been cutting taxes year in, year out. They're not,
Right.
More or less the real tax levels have become much more regressive since the 1970s.
So the way the engineering is going on right now is it's going to continue accelerating this pattern of the top end getting the lion's share, winner take all, while the middle and lower class continue to fight over the scarce resources, if you will. And we have a bought and sold, or the best rented Congress you can buy by the people who are using this money in order to write these laws the way they're writing it. So I see
think
this.
The more fundamental point here is that I don't see the United States or any other country really having what I'd call a long-term strategy,
right,
for getting through the next 20 years and generating growth and jobs and incomes for its people.
I needed to use all that time to set up you can only live off of sugar for so long as a.
That's it.
This is the issue. I want you to speak in the last few minutes of how long can it run for even the wealthiest operation on this setup before it becomes a house of cards for them, which then affects us, of course, and then we bail them out with higher taxes.
For me, the main problems with the current approach are not going to be some kind of grand crisis that's going to teach us a lesson. It is that we are missing opportunities each and every day to have a healthier society where a lot more people are prosperous and better off. There's millions of jobs in the green sector, for example, that could be added if we simply had a little bit of consensus that we're going to lead the world in green technology. I mean, there's no reason why the United States has to be importing solar panels from China. We should be doing a lot of this stuff here, and moreover, the whole architecture of alternative energy sources. At the moment, we've gone the route of developing fossil fuels. So we're now, rather than going into green technology, the United States has become a major exporter of oil again. This is not sustainable. I'm sorry. The world has to get off of oil at some point, and the United States should be simply leading that. It would create, among other things, millions of jobs, high-skilled jobs that people would have to be trained and educated for. And at the moment I'm in Florida. Florida ought to be the sunshine state. They ought to have solar panels everywhere. What are they relying on? Building new nuclear plants on the borders of, the Everglades that are going to take 50 million gallons of water a day. This is insanity. And you can't find solar paneling very much in Florida because the utility here is basically so heavily invested in fossil fuels and nukes that they, have not been sponsoring it. But if you had a right-minded leadership here, you would have a vibrant solar panel installation. Wind, there's all kinds of job potential, high-skilled jobs. But what we lack here is leadership. And, we're getting leadership in the wrong direction.
Well, I want to thank you for coming on, and I'm sure we'll be able to get you on again. James has offered to come out to the Aspen area, and we're going to try to see if we could put together a seminar with the two movies, The Price We Pay and We're Not Broke, and I'll put links to that. Make sure you're following James on Twitter. And is there any other things that you'd like to get our heads around?
Submerging Markets. We have a lot of material there, and also the Tax Justice Network is a good source for basic education on these issues. TJN's website at taxjustice.net, and I'm also have a website called Submerging Markets, and occasionally I write for Forbes, so just to write for all.
And you did a lot of interviews yesterday, so I'm glad you were able to squeeze us in. Thank you very much. We'll see you next time.
Great. Thank you.